at 7:04. Our chairman, Todd Lavieri, cannot be here, so I would like to make a motion to seat Neil Butnick as our chairman.
So moved.
Second.
All in favor?
Aye.
And here's Marie.
All right, good.
Oh, good.
All right, so now you're on.
All right, you want to do the roll call?
Sure. All right, Neil Butnick,
Here.
Judy Neville, Tom Schulte,
Here.
Amy Carroll.
Here.
Todd Lavieri is missing. Michael Chen is absent. Chris Labrie.
Here.
Victor Alvarez.
Here.
Maria Weingarten.
Here.
Robert Hamels on Zoom.
Here.
Colin Dobbin, I am not sure. We will need a motion to seat Bob Hamel
So moved.
and Maria
Second.
Weingarten.
So moved.
All right,
Okay.
Second.
so, all right. So they're seated, both
We have
of them.
approved, so we're ready to go.
Yeah.
Good.
Okay. We got through the roll call. That was good.
You're fine, we're fine.
Okay, minutes. We had some comments on minutes up till now, and we probably have a few more. We're approving now the minutes for the regular meeting of July 13th and then the August 4th, 11th, 17th, 21 special meetings. So Judy did yeoman's work getting all those minutes out. There really was a lot.
Well, all right, I have a few corrections. So who wants to start? You want to start with yours?
Let's vote them one by one.
Oh, you do? Okay,
I
that's
was
fine
doing
with
One by
me.
one,
We
and then
usually
we'll
have.
Deal with the issues as they come up.
Yeah, that's good.
All right, the Tuesday, July 13th minutes.
Good.
Motion, okay.
Nothing.
Second,
I'll second. Neil motion. I second.
Chris.
Chris.
Neil's over there.
Todd.
It's all right. All right,
Todd,
all those in favor? Okay, we're doing well here.
We'll get
Okay.
Linda over.
All right, special meeting. That was a regular meeting. I should have said that. This is the special meeting, Wednesday, August 14th.
Fourth.
Motion,
Fourth.
August 4th. A motion to approve or change or edit or,
Any changes on that, August 4th? If not, let's have a motion to approve.
all right.
So moved.
Okay,
Second.
aye,
All
In
those
favor.
All right,
Aye.
good.
Fourth are good.
All right.
all right.
Next is a special meeting Wednesday, August 11th.
Any comments? Motion to approve,
So moved.
second,
Second.
all in favor?
Aye.
All right.
17.
All right. The last is special meeting August 17th. And
Any comments?
Yeah.
I have a
comments.
comment.
Okay,
Yes.
So on page 2, in the section memorandum of understanding, the second paragraph, the last two sentences are confusing. So I would like to propose that we strike the last sentence. And the penultimate sentence should be changed to any additional expenses related to preservation efforts will be the subject of a discussion between the library and town bodies at a later time.
Will be what?
The
discussion.
subject of discussion between the library and town bodies at a later time.
Okay. All right. Any other
And then
comments?
strike it where it starts none of the funds, or the very last, sentence, any additional expense.
Any
We're striking,
additional
the
expense?
risk
The
is-
risk is protected.
The risk is protected. We're striking that whole sentence.
Yeah.
So it's just that sentence is gone and the previous sentence that starts any additional expense has been amended.
Related to preservation efforts will be subject to discussion between the library and town bodies. All right. Any other edits?
I have an edit and I'm hoping I got this across when I brought it up and I may not have. So in the same paragraph, a second page, paragraph 2, and it discusses that we clarified that the funds can only be for reservation and preservation. But I thought I asked that if the project's moving forward, that there couldn't be efforts to arbitrarily stop payments just because as long as it was going along with the GMP budget, you couldn't, under the memorandum understanding, it was just like if the library incurred the costs, then the town would pay it, and you could not say, I don't really like the project. And I was trying to get that across, and I'm not sure if I actually said it, or I hoped I said it.
So
You did say it, but
You-
it never got in the MOU.
I think it, yeah.
No, but I remember I asked Tom, when I was asking Tom about how it's written in that way, and so that you couldn't, as long as, I just want to make sure that as long as the library,
Well, let me
Go ahead.
state it in its positive terms.
thank
So
you,
the commitment relates to the project as approved by the P and Z approval. So
Right.
The description of the project to which the $10 million commitment relates is in fact a description that is coming right out of the P and Z approval. So that's the project.
right.
So you can't say, oh, I don't like how the project's going because it's tied to
Okay,
that.
so,
That's what
so
it's-
we're comfortable.
I'm
That works.
comfortable with
Okay,
Yeah,
fine,
it
all
was
right.
tied in.
So are we adding
no.
anything? We're okay.
No.
All right.
okay, so we're good. Any other comments on the 17th or any other special meetings or the regular meeting? Okay, let's approve that last one then.
As amended, so approved, I'll make
As
that
amended.
motion.
As
Okay,
amended,
I'll
yeah.
second.
So it was
Maria second.
Tom.
Maria second?
Yep,
That's
you
fine.
seconded, Maria?
Yeah.
Okay, all right,
Tom moved.
all right.
Okay. All in favor?
Thank you,
Aye.
people.
All right,
It's a
okay, all
lot.
right, so that we're done with the minutes. Now, Kevin is not coming tonight, right, Tucker?
Right.
And so we will skip past that section. The main point of tonight is the investment performance of Vanguard. Brian Bakley's here with us today. We just had an RPAC meeting before this. The results are, what one word would you pick to say what these results are? Phenomenal, phenomenal by the money manager. He says they're phenomenal, and they are. We have a fiduciary responsibility to come 2 times a year and gather together and speak. This is our first one. We'll be making decisions next summer on things like the discount rate allocation, if they change at all. But that's coming up on the docket. This was really a performance presentation, and you get to do it in front of the whole Board of Finance, which is nice.
Nice to see everyone in person.
Right.
Good, thank you for having me.
So I'll leave it to you.
Okay, good. Good evening, everyone. Again, it's Brian Bakley from Vanguard, and good to see you, Sue. As Neil said, I was going to recap the performance of the markets, just the markets themselves. That's in section 1, as well as the performance of the 3 plans. The other sections I have in the presentation is something on the discount rate, also just our general outlook, and then in the very back, section 4 of your presentation are the fact sheets of the funds that are in the plan. And I'm glad to take questions as we go along at the end or both, so interject whenever possible. So on page 4, which I've turned into, just to recap how the markets in general have done, and this is as of July 1. I'll bring your attention on the left-hand side, on the bottom of the US stock. We'll start the stock markets. The middle bar is the year-to-date number, and that far right bar, the lime greenish color, is the 1-year number. So on a year-to-date basis, the US markets are up over 17% year-to-date. I was just telling the RPAC, I think there's been 53 record highs just this year as far as the equity market is concerned. And so on a 1-year basis, you see the US equity market in total up over 39%. To the right of that is the non-US markets, that's both developed and emerging market equities, behind but still positive. So up 8% on a year-to-date basis and up over 29% on a 1-year basis ending July. I'll come to it in just a moment, but in the middle section, just looking at the fixed income markets, you actually see slightly negative numbers, down 0.5% year-to-date and 0.7% on a 1-year basis. And that's due to interest rates actually rising over that time period. There was an inverse relationship between rates and prices, and so you just see fixed income negative. Page 5 goes into the different segments of the US equity market, both looking at large cap, mid cap, small cap, and value and growth, which you often hear and use. The three portfolios that we talk about are invested across all of the segments of the market. So you're capturing the returns of all these segments of the market. You know, in a one-year basis, you see small cap up 47%, so well over large caps, as there's been a return of risk appetite into the markets. On the right-hand side, the value and growth, that is rotated, you know, just as the Fed is talking about interest rates, or, you know, we're getting different sectors of the recovery happening, but again, you're capturing all of that.
Just to put this in perspective, is this, how often does this kind of performance happen?
It doesn't.
It's
Never.
I think it's
Never.
really, it's a phenomenon of the base effect of where we were last year. I mean, you know, we bottomed in March of last year, you know, when the markets were down 30%, over 30%. And so part of that is just a recovery from, you know, the pre or depths of the COVID market. But you rarely see returns like that. And that's why I don't use that term lightly, phenomenal, as far as the recovery in the markets. Yeah, you rarely see those type of numbers. Page 6 is looking at the yield curve. This is just interest rates at all different maturities. And the bottom line of that grayish line is what rates were a year ago. And so since that time, rates have moved up. That middle line, or the dark blue line, is where we are at the end of July of this year. So that ties to the performance of the fixed income markets I just talked about. So rates have moved up slightly since we were last year, again, really low last year because of the effects of COVID, and therefore led to that negative return in the fixed income markets. Page 7 looks at
Is a page 6, what date are you on that? Is that,
page 6 has three
7
different dates.
it's
of those
7:30.
lines.
Okay.
But that-
and we're still, I think it's still 124 for the 10-year, right? I think we're there.
Yeah, the 10-year as of
Close
September
business.
10th was 1.35.
Okay.
You know, so, you know, we saw rates come into the year very low. We peaked in March, actually March 31st to be exact. The 10-year was at 1.7.
Mhm.
You know, rates have come down since the peak, but they're still up, you know, from the beginning of the year. Is that?
Yep,
Is that
yep.
guessing?
I was just off on a
Yeah,
date.
sure.
Thanks.
Sure. Page 7 is just looking at the different segments of the market. When you often hear talked about how the fixed income markets have done, it includes both treasuries and investment grade credit, which on the left-hand side, it does not include, and the portfolio does not include any high yield. We just put that as far as a reference point of how that part of the market is doing. And again, as the appetite for risk has increased, even high yield has done well, but that is not in the portfolio. It's more of just treasuries, investment grade credit. Credit spreads are at all-time heights as well. So with that, I'll just turn into the performance of the actual over 3 plans. That's starting on page 8. This is as of June 30th, so the end of your fiscal year. And so for the pension plan, on a one-year basis, where the plan was up 25.99%. So phenomenal one-year returns that will help the funded status, but the funded status of the town's plan is already very strong, but this will only enhance that. At the bottom of page 8, we look at the policy, how your asset allocation looks against the policy targets. So the policy targets, for a reminder, is 43% to US equities, 23% to international, so 65% in total to equities, and then 35% to the US fixed income market. That's all investment grade. With the appreciation in the markets, you'll see we're slightly above the policy targets on the equity side, and then the inverse is true on the fixed income side. We do have, and we do set rebalancing targets of plus or minus 5% whenever it moves away 5% at the asset class level. And so last year in March, and then even in November of last year, we were underweight or overweight equities and we rebalanced. That actually helped the overall portfolio, that disciplined rebalancing. And on this page, that's why you see with an all index portfolio, the performance slightly over the composite benchmark, that disciplined rebalancing of buying equities when they're really weak and actually selling them when they're really strong.
So this group had great foresight.
2020.
Well, it's probably worth mentioning that there was at least a conversation on whether or not
There was.
the asset allocation policy was worth keeping at the depth of the drop in March of 20.
That's
And
right.
we decided, the beauty of having a policy is it's a policy and here we go. And it did work out in our favor. Yeah.
Right. That's one of the tenets we believe to lead to long-term returns, not only broad diversification, keeping costs low, all of which the town's following, but also being disciplined. Discipline is sticking with your asset allocation once it's set, but also rebalancing. Feels
Right.
real uncomfortable buying equities in March, but again, it turned out to be the right decision.
Right.
So those three components, we think are all three principles that lead to investment success. And that's been the case across all three plans.
And one of the conversations that the RPAC is going to continue with Brian is, of course, now given the oversized returns and the outperformance of the equities in the balancing, if we're overweight on the equities and underweight on the fixed income, we would be looking to rebalance, meaning selling those overperforming equities and buying an asset that was flat to slightly negative.
Yeah.
That doesn't feel particularly good, but nevertheless, it's the discipline of the policy and it's what you should be doing. And that's why these percentage targets were put in place in the first place.
Yeah, absolutely. Yeah, thanks for that comment. If we flip to page 9, this is just looking at the individual, the three funds that are in the portfolio. And what I always give the assurance is there's 3 funds, but these are extremely well diversified. So that US total stock market index, that's over 3,500 securities. The total international stock market index, that's 7,500 securities. So you're balanced across all market segments, all style segments, and you have broad diversification, even with 3 funds. So looking at the 1-year number, this is as of June, the total stock market index was up for over 44%, the total international stock index up over 36%, and then just in line with my other comments, the fixed income was slightly negative at 0.4. Page 10 is looking at the performance of the OPEB plan. The OPEB plan has the same policy targets. The actual numbers may be slightly different because there's different cash flows. Pension has cash flows in and out on a monthly basis, but the results are on top of each other. So the 1-year number for the OPEB plan, 26.09%, and that also is within all the targets. Slightly more overweight equities than the pension plan, but still within that 5% threshold.
So with the gain in the OPEB account, where are we in terms of funding the OPEB balance? At one point, a couple of months ago, we talked about maybe making a contribution to it so that we get, we're at 60 odd percent. But I'm wondering with that gain, whether we've made some real progress in terms of funding more fully the OPEB. Linda, would you know that number?
But compared to,
I do recall we did have the discussion, we went back and forth whether if we wanted to fund it beyond the 60, then we talked about possibly issuing pension obligation
Right.
bonds as funding.
not needed.
And I think there was some opinion is whether it's not something that towns or municipalities typically do.
Yep.
Because right now, it's on a pay-as-you-go basis. The money that comes in pays the obligations, and so it's not in any danger of being underfunded, even at 69%.
Okay, so if it's 69%, that means that we've gained some ground on it because we were in the low 60s at one point in our funding of it. So if we're at 69, we've gained 7 or 8 points by virtue of market action.
Yes, and the actuary will put together the valuation report, but I don't know when that's slated. I don't have insight into that. When the valuation report will come out from the.
That's
actuary.
summer too, Diane, isn't it?
That's
Yeah.
another valuation. They can look at where we were fiscal year end.
Yep.
And it's definitely above the 60%.
Yeah.
Which,
Well, Nick, so this market is helping.
Well, it goes the right way.
yeah, but it could retract,
Right,
so
it
it's
can
like,
go the
it
other
looks
way.
sweet now, so.
Yeah.
That's why
Yeah,
he's the
but our
chairman.
OPEB funding is exceptional for most municipalities. I mean, it's
No,
just,
we're
As
very
good as you get.
it's one of the biggest unfunded obligations across the country.
It is.
So we're in
I
good
mean,
shape.
One, it's great that the town has set up an OPEB trust. Not every municipality does that. And then for comparison's sake, the average funding for an OPEB plan in the state of Connecticut is around 33%. So, it is well funded, just to, by way of some comparison numbers.
Yeah, okay, good. Thank you.
Okay,
Yeah, so I'll just get past page 10 because again, the numbers of the allocations you see in the pension plan. And on page 12 is the Mildred Marsley Trust. And also the asset allocation is just slightly different, but very close in that 1 year return of 26.81% reflects that. It reflects that somewhat higher equity allocation. You see that it's 46.7 to be exact in the bottom of page 12. The policy targets is set up to be 2/3 equity, 1/3 fixed income, and that's why you see those very specific numbers. That's well within targets. We don't really have cash flows there except the interest income. The next several pages I just put for reference is just through July. I really just wanted to focus on the fiscal year, so no other comments there. That's for the commissioner's reference. I could touch on briefly just our forward-looking forecast for the asset allocation is up for the moment. So on page 22 in the next section, the one thing that we often update for the actuaries and to all our clients is we look at the asset allocation target, which are here on page 22, and then Vanguard has capital market projections. What do we think that those asset classes will do over the next 10 or in this case 30 years? On the right-hand side of the target, the 50th percentile is in the middle. So looking out 30 years at the median, we're looking at a forecast of 5.69%. We always provide a band or a distribution. Anytime we're talking about a forecast, it's important to have a distribution. And so that, the low 4.97, but the 75th percentile up to 6.4%. And that number just reflects where we are with the gains in equity markets, but also reflects historically low interest rates for the fixed income market. If that number, reflects somewhere as low compared to where we are. So we do provide that again to the town and to the actuary to help decision making around that. Any question on in particular estimated return forecast?
I think it's good we get comfortable with the modeling on that,
Yeah.
just in terms of how you get to arrive at that and forecasting and all that. So, is there like a little piece that says our model and?
Yeah, it's a model, right? And, subject to any kind of changes, big inputs on equities is what's the valuations in the market. That's a big input, what are the dividends you're expecting, earnings, that goes into any kind of forecast in the equity markets. With income markets, big piece, no surprises where you are with interest rates. And so we're certainly not alone in the industry as far as bringing down forecasts for asset classes, given where we've been in the last 10 or 12 years, equity markets. So I don't think that we're too far off from those forecasts from coming down across the industry.
Yep.
It's the reality of we've pulled a lot of gains forward in a low interest rate environment. And then I'll just leave the committee just some closing thoughts on page 26, just from an outlook perspective. Of course, with the reopening of the economy and vaccines, we're expecting very strong GDP growth numbers, in the US, but also around the world. But really, it's been questions of interest rates and inflation in the hot topics. As far as inflation, we continue to think, as does the Fed, it's transitory. We're coming off of high numbers because of the base effects and the reopening of the economy. We'll see that inflation forecast coming down closer to 2% by year end. It's a little bit slower to fall than we thought a year ago, but we still think it'll be by the Fed target of 2% in the first quarter of next year. Our thoughts both, echoes the Fed. We're not seeing a Fed rate hike before 2023 as of this moment. There's still slack in the unemployment, and that's the other measure that the Fed looks at beyond inflation. So those are the major pieces of inflation and interest rates that investors are most concerned about, and rightfully so.
Have you guys, and everyone's talking about this, but with the difficulty getting the vaccination out and the Delta virus and the impact on the economy that we're seeing, people closing down, and especially in certain parts of the country, have they looked how recently have they updated their forecast in terms of sensitivity to the enduring pandemic negative pressures?
Yeah, we just released a paper this week, so I can make sure that the committee gets it, to re-looking at that inflation. And that's one of the supply bottlenecks that are still remaining in the economy, maybe been slower to dissipate with the spike in Delta. So that's why it's taken a little bit longer for the inflation to come down, but still within that realm of decreasing of bottlenecks, loosen over time. So
Yeah, I guess I was thinking less of inflation and more about negative, less optimistic rebound from the pandemic.
well, that's right.
Yeah, in terms of the economic growth
Yeah.
forecasts. We just saw the inflation numbers came down last month, so they're on the way, but not the inflation so much, but just in terms of economic activity.
Yeah, well, it's still supported in a great deal from low interest rates from the fiscal, monetary, and then there's still all the fiscal stimulus and more packages in discussion. So if there's more fiscal stimulus, that'll continue in our minds, surprise to the upside, but that's an unknown right now, what gets passed in the US government. So still a lot of cash out there to be invested at the company level and individuals. So it's a rebound. That's why you see a strong growth rate for 2021, but normalize at some point.
So just so I understand, going back to page 22, you're saying that our particular mix of equities, international equities, US equities, and bonds will earn 5.69% each and every year for the next 30 years? No.
No, just over that 30-year time horizon.
After earning 26% in the last 12 months, we're going to earn 5.6% over the next 30 years?
The next 30 years is that forecast. Yeah, but not in and out every single year. Of course, there's a lot of volatility around that number on an annual basis.
Oh, here.
But that number of 5.69, I don't know what it would have been 5 years ago, but with what happens, it would have been much higher than 5.69.
Yeah, that's a 7-something.
Right,
Yeah.
right.
And historically, that's the number. If you go back to very long.
The 80-year.
Yeah, like 80-year numbers, 100-year numbers.
Okay, any other questions? I want to move along. Good.
So one question, when do when do we look at our rate of return? Is that in June?
This summer, yeah.
Summer
Okay.
22.
Okay, and I sent everyone our from Bloomberg,
Yeah.
which was talking about the returns across the country at 35%, in New York State, which is a well-funded pension plan, going down to 5.9% return.
Right.
Yeah.
So I just think that's, because like this is a once in a lifetime, probably this
Probably,
level of
but-
return. And then you're going to have years when it goes down.
Right.
So we're well funded, but so much of being well funded is being conservative in your assumptions on your returns.
Yeah.
Mhm.
But, whenever you have a shock system, you get these big rebounds. So after the financial crisis, you had the 35, 37% downdraft, and then the following year or two, you put in 40 and 20%. So there was, those things happen when you have big downdrafts, you kind of
Right.
revert to the means.
Yeah, this was a faster
This was.
downdraft and faster up, and it was
It was-
multiple years.
Yeah, it was
before,
very
so-
fast.
You know, it was the sharpest bear market I think we've ever had, but it also was the quickest recovery, out of recession, but in the
But
market.
we've never, the government's never put a couple of $1 trillion
No.
of stimulus into the economy either. So,
But Amy's point is well taken, is that plans across the country are lowering the discount rate given
Yeah.
where you are. So if you just look at the last 10 years for the US market, it's up 16% over the last 10 years. So anytime when you're doing forecast, a big point of your starting point is where you are with the valuations of the market. And given what I just, talked about the historic returns, you're coming from a higher point. And so the forecast for equities are lower, and then, sorry if I keep repeating, but we're at historically low interest rates at,
Yeah.
zero. And so that hurts investors because there's less yield. Over time, higher interest rates will be good for investors. We're just not there yet.
Yeah.
Really, you want higher interest rates to get some income from our fixed income. portfolio.
Amy, on 23 is a pretty good kind of comparison of where we are in our discount rate relative to other communities in our kind of competitive pool.
Great.
The other thing to just note is that RPAC is having continuing conversations about whether or not there are other strategies to help us perhaps not give these oversized returns back to the market. We're not saying that there necessarily is, but if there is a strategy that we can think of that might, play the same function as a hedge. It's not hedging, but whether or not there's something that we might consider in an environment that might see, falling fixed income values and also falling equity values, and would we want to be in a position of giving out? But those conversations we have all the time, and we're going to continue to have those.
Yeah. You have to be conservative, and we
Yeah.
certainly
Yeah.
acknowledge that.
Yeah, absolutely.
Okay, I think that's good, Brian. Thank you so much.
Okay, thank you for all the-
Thanks, Brian.
And it is phenomenal. Your word
Yeah,
is
we,
right.
we agree with that term.
Now, next year, we may be crankier.
Yeah, we
Right.
maybe.
But we're well funded and well balanced, so that'll be good.
Okay, Linda, financial update.
I want us to. move. Well, it's better.
Is it phenomenal, Linda?
It's better, that's fine.
Excellent. That's-
So this is just an update from where we, when we last met, and I provided you some update of year-to-date numbers. We are closing out the books. We've given the final numbers to the auditors, and so these numbers are really close to final. So if any changes would be just some minor budget adjustments that the auditors would make as part of the year end. So I did give you a two-page sheet. And so I'll just kind of walk you through what those numbers are. So the second column on the sheet that you have is the FY21 budget that was approved back in May of last year. So the very last number, you'll see the total approved budget was $152.2 million. That's the budget approved in May. During the course of the year, the Board of Finance and the Town Council approved two special appropriations, which increased the budget to the 155.7. Those two were, we did 1.5 million to transfer to the Board of Ed non-lapsing fund for COVID in FY21, which followed the 400,000 that we did the prior year. So we did 1.5 million in the non-lapsing fund in FY21. And then you'll recall that few months ago, we did an additional appropriation to the internal service fund of 1.9 million. Said we'd wait and see when we did the budget, instead of putting it in this fiscal year, we put it in the year prior. So the 1.5 plus the 1.9, a total to the 3.5, and then that became the revised budget for FY21. So it's those two numbers that were added to it. And then the third column in the FY21 number is year to date, which is where we ended the year so far. So we ended the year at 155.3 on a $155.7 million million budget. So we came slightly under budget to the revised. But I'd also like to point to the fact that in FY '21, we did have some COVID expenses that we had not budgeted for. We were going to draw down the fund balance. So included in that number, you'll see that we have about 486,000 in COVID expenses and 250,000 in the storm Isaias expenses that were part of that as well. So those were things that we didn't budget for. We knew that they were coming, but the strategy was we would draw down the fund balance, any reimbursements from the federal government into that. As I said before, we are eligible for $6 million in reimbursement. We've received $3 million so far, and we received $3 million this fiscal year for a combined total of $6 million. But we have not accounted for those funds in the general fund. Those funds are in a set aside grant fund, and so that $6 million we receive 3, but it's not part of these calculations. So that funding is there, but it is not part of this number. So then if you look at the second page of the sheet, is just tracking the revenues. Again, the same logic, we approved, and the total revenue number is the first subtotal number that you see is 147.7 was the budget that we approved. Initially, when we approved the budget, we had approved it with a $4.5 million fund balance drawdown. So now on the revised budget, we did not revise the revenue numbers. They're the same as we had revised. However, the fund balance drawdown, you see that increasing because we did that additional funding for the Board of Ed, and we were going to draw down the fund balance. And then the very last column is the actual performance of the budget. So on a 147.7 million, we brought in 149.8, about a little over $2 million over the budget, the revenue budget, which is consistent with how we budgeted in the past, the collection rate. So that number came in strong as we had expected. But as I shared before, because we had those additional expenses on the Board of Ed side, and we were going to draw down on the fund balance, so we actually will be drawing down about $5.4 million in the general fund balance. Again, this does not take into account the $6 million that's not part of this number. So keep that in mind, that there is $6 million that was intended to be applied towards this, and depending on, I know there's a discussion after this on what happens with those funds, but that's there. So overall, it's great, great budget performance. It's consistent with what we had budgeted. Nothing unexpected happened throughout the year. The current fund balance, total fund balance, even with that, without accounting for the ARPA funds that we're getting back, is total fund balance of 29.4 million, which is about 18.9% of expenditures for the past year. You recall that the GFOA's best practice is somewhere around 16%, and our internal fund balance is at 10%. So we're perfectly fine in terms of the general fund and the fund balance and the funding that we received from ARPA.
Linda, that's without the 3 million or
This
6
is
million.
without the
Thank
3
you.
million.
Thank you.
So if you were to add that,
Mhm.
that would even boost that number.
Yep.
And then just for your information, in FY '22, you see that we have a budget that's approved with a 5.2 million fund balance going back to our historical performance. We will more than likely bring in tax revenues above what we've budgeted. And in FY '21, FY '22, we don't anticipate those additional expenses that we had this year. So we don't anticipate any additional funding for the internal service. I don't believe we'll have the level of COVID expenses this year or anything like that. But that's kind of a snapshot of where we ended in FY '21. I believe we ended well. We will now conclude the audit with these numbers, and then I believe in November or so, we'll present you with preliminary audited financials, and then in December, we'll give you the actual audited financials. But short of some budget audit adjustments, this is pretty much where we anticipate the year will end. Happy to answer any questions that you have.
It's good.
So it's very good.
Phenomenal.
Yeah, we did all right.
Do you want to just move right into ARPA?
Sure. So the discussion on ARPA, as I mentioned, we've received, the $3 million this fiscal year and last fiscal year. and we'll be receiving $3 million this year. The plan is for the Board of Selectmen is gonna be bringing this up at the next meeting to kind of have discussions on how the funds are allocated. We had a focus group in here by the Buchanan Foundation about what to do with the funds, but basically, I think this item here was just to have conversation amongst the Board of Finance and the three members that are kind of appointed to kind of go back and forth and to provide feedback to the first selectman in terms of how these funds should be managed. We did survey a number of towns in Connecticut and what they're doing with these funds. It's kind of all over the place. Every community is doing things differently. I saw, for example, the town of Manchester, they had a survey that they put out on their town website for citizens to just go in and prioritize where do they want the funds to go. Some towns it's just the town council that's kind of put a group together and having the decisions. I'm trying to remember what the name of the town, I believe is, I think it was Richfield. They kind of had a meeting, a town meeting similar to what we did here, and just have townspeople come and provide idea and feedback on where the funds goes. But I think it's ultimately the boards to kind of give us direction and where we want that to go, and then ultimately the town council as a matter of how we allocate this. I did provide you the list of eligible projects that we could apply this for. The intent of the ARPA funds is to stimulate the economy. So other than reimbursing yourselves for lost revenue, it's really looking forward, what more can you do that you wouldn't otherwise do? And therefore, so even looking at the capital projects, I mean, we have capital projects that we're gonna do anyway, but I think the intent is to kind of start thinking of things that we wouldn't otherwise do did we not have this, because we're still gonna fund the capital projects.
And with that, also with health and safety being one of the objectives,
Yes.
right?
that
You know,
helps.
Stimulus and health and
Yes,
safety,
stimulus
stimulate
and-
economy, health and safety.
Premium paid
Yeah.
for health safety, the front line.
Right.
Yes.
So is there a clue in terms of New Canaan and?
So we, next week, Board of Finance, the three of us in the Board of Finance, and then with the folks at Town Council, are having a joint meeting to have put all the great minds together.
Yeah.
So, and the date's not set yet, but it'll be posted and everything, so.
It's exciting.
What about, we have the 2021, 2022 budget already hashed out. How much of what's already in that budget can we use to suck up some of that $3 million?
Well, the way that the plan is designed, you could apply it to lost revenue. And I think I shared the revenues that we lost historically. So you could apply that in terms of the budget that's been approved, could apply towards that, which would add X amount of dollars to the fund balance, which would help offset any fund balance draws in the current budget. But based on the criteria, there's not really that you can use to supplant the budget that's already been approved. There are some capital projects that are in the 5-year plan that we could look at that could possibly meet that criteria. And so I think you could probably do more applying towards the capital budget versus anything else. I did share with the board, I think the Board of Selectmen and you last month, we did enact the what do you call it? For the volunteer tax relief for the volunteers that we have in town. We did not budget for it. We were just going to use excess fund balance, and therefore that is something also in terms of the budget, the FY22 budget, that you could apply some of those funds for if we so choose. But the plan was to use the fund balance to fund for those. But those are some projects that are already approved that we could apply these funds towards.
Good. I think we're good.
Yeah, but you know, in using these funds, they're one time. It's a one-time thing.
Yeah.
So I think the focus, I would guess most people, we're not looking operating. We're looking at to move something forward we wouldn't have otherwise. And the great thing, correct me if I'm wrong, you've already gotten 3 million, right? So we've already got the reimbursement stuff. So that gives us great flexibility. The other money we have to spend for purposes within a set period of time. So half of it, we already have flexibility to apply. And the other stuff, we have to do a little more accounting on it as we track it.
It's a great thing. Good.
Oh, it's, yeah.
Okay. Bill and Tiger, you want to talk about Gore's Pavilion? Thank you, Linda.
The first item up is the Gore
This is
Pavilion
me.
roofing project. We're requesting approval to accept the grant from the Connecticut Department of Economic and Community Development in the Historic Restoration Fund. We qualified to receive $59,700 that was approved to apply towards that project. Early on, we had anticipation that we were going to receive this grant, so we did reduce our budget during the budget time.
Mhm.
So we just need you folks to accept the grant so that we can move on with the project.
We approved the funding. That was already done on, in a vote. So this is just the acceptance of the
Right,
grant.
just
Yeah,
the acceptance of accepting the grant, yes.
all right. I'll also move. I'll second.
All in favor?
Good job.
The next item we have is Carriage Barn renovation project.
I'll start off with that.
Good.
So you recall that when we've historically brought to you bond appropriations at every year, we group projects within, for example, when we have public works projects, we group them together, parks projects together. So we had a number of projects, town building projects that were grouped together. And the reason we group those projects together is to allow flexibility amongst those projects. If one project was over, one project was under, we could move money between those projects without changing the total appropriation amount, which is what the, because we bond, that's the clause that the IRS requires us to have.
Mhm.
And therefore, what we're doing here, we've identified and we've listed those projects in the memo. There are a number of projects that are running under, and there's some savings in those projects. And so what we're asking is to apply, to transfer that, there's about $80,000 in various projects, and to apply those towards the Waveney Parks project. And so instead of bonding or asking for additional funding from another source, we're just reallocating funds within that bond authorization. And that's what this request is.
So one question is the 80,000 and change, is that the limit that the Carriage Barn project needs? Or is the 80,000 the limit of the underspend that's available? Because it's an odd number, right?
Mhm. Sure
It
is.
is
So I
an
don't
odd
know
number.
what it is.
It's more than, it's more than doubling. the co-
Right, and so I'm
Price.
just
So
wondering,
what the heck happened?
Yeah,
Yeah.
that was my
That's what
question.
it is.
What happened?
Right on here, right. So we did go to bid for this project, and there was some time delay with the COVID thing, getting things going with the project, about 6 months.
Bill, would you remind me, is this the bathrooms? Is that what the project?
It's the bathrooms, it's the whole.
Just what the- what
every
exactly the project-
Apartment in the Carriage Barn,
Right.
that all is come now, and the whole thing is all gutted out to redo the whole space. They forfeited the revenue on their apartment. They also donated 50,000 towards this project.
Right,
We wanted to build, we had to get ADA compliance under our
yeah,
belt
Oh,
here.
but it's bathrooms
Sure.
mostly.
So- And they wanted a little conference classroom area. They wanted to step up, and they want to go to a 4-season venue there. They also, on their own, put another $45,000, I think it is, to put central air conditioning in the building and everything, so they can have a 4-season venue there. It's a good project. They want some nice finishes in there. That's why they donated that 50,000.
50 on top.
On 45.
40 and so,
Yes, so it's
95.
95,000 that they
95,
contribute
yeah.
to a town building, yes.
okay.
So when we got the project going, as you all been watching the world, the inflation is hitting everybody hard. We're not exempt from that. So we've did a lot of value engineering here. And so we were trying to absorb that within the contingencies and value engineering. It just became a little problematic when we did the demo piece of it. We uncovered a lot of structural issues. And we're not over 100 years old, that barn, but it went through some changes, obviously from a barn to a carriage barn,
Mhm.
arts center, society venue. So we had to address all these structural issues. We warned also at one point sometime, there was a small fire in the building years ago. So we discovered that behind some walls, so we had to fix that. And one of the other issues that came across from what I learned was, I think it was about 1970, when they actually did the Carroll House and the Carriage Barn, they tied the two buildings together. And in doing so, tying the buildings together, they did some infill in between the two buildings, which unfortunately, they did not understand what would happen over time. And the carriage barn being a nice field stone construction, by backfilling against it, it deteriorated the mortar and everything between the joints of stone, which transferred moisture into the building.
Mhm.
We knew there was some moisture problems there, but when we opened it up, we never realized how bad it was gonna be. It was would have deteriorated the mortar, poured out of the walls like sand. So we ended up paying a big expense there to fix that problem. We corrected it. We had to.
And where was that
That was
exactly?
on the carriage barn on the exterior,
On-
and then the moisture went through.
In what side?
Right in the right front corner
To how
of the
far?
carriage barn.
To how far?
It went down to the bathroom, about 12,
Really?
15 feet. And we did correct the problem, and then we had 4 inches of rainfall on it and it didn't leak.
Yeah.
So we tested it. It was a very
Yeah.
good test. We're very happy that it did work because we got really creative on how to fix this problem. And we put a couple of different contractors together, discussed it with them. And we had all the Bailey also involved in that discussion. They were doing the Waving House. Very good at restoration projects, and they helped us correct the problem. So we have a beautiful building there. We don't want to lose it. We want it to be going for another 100+ years. So we want to make sure that when we're done with this renovation project, it's good for another 100+ years.
Yep.
You get it right now and not open it back up later.
So what's the total? I mean, this
Yeah,
is,
it's-
I can't
it's
turn this, I'm
pieces.
sorry. What's the total?
Hmm.
So,
Yeah, I'm sorry, I don't know. how
There's two
to-
problems. Maybe you
Yeah.
could go through
right,
There's-
so
two projects.
there's 2 projects within one here. So when we had the bathroom projects, we were working through this for the past couple of years, the design, trying to get these together. The carriage barn folks were doing some fundraising because they wanted to contribute, so we lost a little time there, which was fine. We wanted to get it right, rather be a day late and get it right than, jump the gun here. So when we created the first project, we had, I can't remember, I think it was $60,000 or $80,000, something like that in there. And then we were able to finally have a design that they wanted and they're contributing. We came back last year and got some additional funding for the project. But because of the different years and authorizations, it's had to be 2 different separate projects. Then we had the money donated, and then now we're having this transfer. So we're
All in,
all in.
Over a couple years,
We
I mean.
should be a little under 300 with the whole entire project, with all the repairs, the actual repairs that we were.
and the carriage barn is putting in 95 of it, and we're getting, is that right? The
Yes,
carriage,
yes,
and
yes.
and then this,
You deduct their donations from that.
right, and then
What's the whole project again?
Renovating.
300,
300.
300-ish?
It's
Or-
300-ish minus the donation and the money they put into it.
And how much did we put in the budget?
It was over a couple of years.
Oh, over,
Two-
well, yeah,
yeah,
over
total,
2
yeah.
It
years,
was-
yeah.
Oh my gosh, give me one here. It was 123 last year. And it was like, I think, 65, something like that, 69, something like that. That was the total that we committed to it, yeah,
And what was the contingency?
20,
20,000? So we went through the contingency plus.
right? So this transfer will include keeping the contingency whole. Yeah, I'm feeling good about being past all the risk at this point because we really opened it up and fixed everything. So
But we used the contingency already.
we did.
Yeah, and now they're
All
gonna,
right.
now they're gonna use 80,000 from projects that came in under budget.
Yeah.
So,
Are these bathrooms going to be available at all to the public, or is it just for
Well, it's
No.
going to be their
just their events?
There are events and everything, and we're gonna be open full-time year round now. So we're gonna do more events.
So semi,
Yeah,
Summer.
semi.
all right.
And we're confident that the 80 is going to cover us to get it open and done.
We're gonna make it work.
What about the 26,000 of escalation of materials cost? Was it just one material that was the bulk of that escalation, or was it just general inflation?
It was general. I mean, across the board, lumber went up terribly expensive. It's
Yeah,
starting to
came
come
back
back down a little
Now
bit.
it's gone down.
I
So
don't necessarily think it's ever gonna get back down to pre-COVID pricing right now. We ran into problems with that. We ran into labor costs going up a little bit as a family job, but also the lack of labor has driven the labor costs up on supply and demand, believe it or not. Plumbing fixtures are very hard to get. It's going to be a little bit of a challenge. Trying to set completion dates are or forget about it. I can't guarantee anything at this point, because there's things I just can't get. And they're out there. And so, so it's a little bit of everything. You can say that it drove it up. But plywood was our biggest one. It went up 400%. And just so you know, there are some other town projects that we are doing that I had time to defer until next spring. I'm waiting it out because I don't like the 400% increase on plywoods and stuff like that, and it's got to come back down. As soon as Canada gets back into full swing, a lot of lumber comes from there, it should start bringing the market down. Let's just hope that we get through this winter with no more big close shutdowns or anything.
Mm.
Yeah, it's between the fires out west, the lumber comes, obviously, and then Canada be shut down. It's been a tough year.
But we had a contract for this, right?
We do.
I mean, at least the initial part.
We did, and
So-
we were close to keeping within the contingency, but then we started running into some problems.
Yeah.
We really tried. We said, listen, let's get the contingency. We see escalation. Let's do this. And unfortunately, when we opened it up the project, we said, holy crow, look at this. We have all these structural issues.
Well, that's good you opened it up.
Yeah, of all projects, this one became very challenging with the structural issues. There's a loft up above it. And then it was just different type of construction they did 100-something years ago. So,
It's a 100-year-old building.
Yeah.
You always
beautiful.
have
It's
problems.
beautiful,
It's
and I-
gorgeous.
you
Yeah.
know,
Yeah.
you know, when you look at it, you can say, well, I'm glad we caught this now, that so these structural issues don't
Yeah.
rear their ugly head in a bad way. We caught it, we saved it, we're gonna protect it and do it right.
Hey, Bill, not to be slow here, but I'm being slow. So I'm twisting this. So the original budget was 243. Is that if I'm looking at your horizontal
Yeah,
sheet?
that was,
both projects.
that was for a combination of both, yeah.
And so the renovation was 217, and is change order 1 and change order 2, are those outside the budget? So if I took those two together,
Right,
and just,
so
this
change
would be
order
a
one was-
57?
Right, so the cost
Yeah.
escalation was the first change order to get the materials back.
Yeah.
The whole,
Okay.
and then the second change order system mostly involved the structural issues and some of the rot we found in the floor and what have you.
Right, and then the other miscellaneous stuff, okay. You know, it would be awesome if you, in the future, when you do, if you could bring like kind of a picture. I mean, so we,
I'd be happy to.
you know, just because we only see it when we approve it, but then, you know, when you're saying, okay, is this a good use of another $80,000? And you go, yeah, this is what we got. I mean, pictures help me on this one
We
to
could-
understand the whole
we-
project.
We
but-
we photo document all our projects.
Yeah, no,
from
sure.
Start to finish, and I can always put a PowerPoint together for
Yeah.
folks anytime. Sometimes we get so involved in things, we forget those little things.
No, I get it.
I'm
I
not
get
saying
it.
if an email comes across, like, see picture, I'm more happy to share with you.
Yeah, no, I think it would make me understand it.
No,
more.
I agree.
Yeah.
All right. So what we're approving, any more, because I guess we're approving the transfer is where we're
Hmm.
approving, right?
Right.
Yeah,
$80,923.46.
right.
And we're transferring that from what to what?
So you have a list of projects.
Yeah, I saw that.
There's 1, 2,
From
3,
the
4,
project.
5 projects that are coming under. And so we're moving the unspent monies from those projects into this carriage barn project.
And they're all done. All those
Yes,
projects
yes.
closed
So
down.
once
So
this is done,
that's
they're
what we do
closed
when we
out.
close out stuff.
Right.
So
And
we're
next
using
year
it.
I'm gonna bring you a list
Yeah.
of projects that are completed to be
Mhm.
closed, and these will be on that list.
Right,
together with
right.
some others that are done.
Right, right.
Got it.
Okay.
All right,
All
all
right.
right.
Anything else,
Do you need a motion to
Questions?
approve?
Motion to approve.
Yeah.
So moved.
Second.
Second, all in favor?
Aye.
Aye.
Thank you very much, folks. You have a good evening.
Thanks, Bill.
Thanks, Bill.
So agenda 9 was the approval of the transfers that you just did. I don't have any additional transfers this month. And then number 10, I provided you a list of transfers. These are just informational. This is just moving funds between the line items. I already shared with you where the budget came in. And this is just to clean out the negative accounts to make them positive. But it's just moving money from within the appropriated budget. So
I think your item 10 is the same as your item
Yeah.
9.
9.
5.
We always have approval.
9 says approval, 10 is review.
So we should do review.
First?
Review first.
Right.
Right,
Review
on
all.
our tablet, there is no 9.
Yes, there is no 9.
And 10, the actual document that's in there is the same as your number 5.
Oh.
Yeah.
I apologize.
No, it's all right.
Okay.
Fill us in,
So
help us out here.
I can email that to you, or we can table that, if you'd like me to bring that in October with a list for approval.
Sure.
Yeah,
All right.
That sounds good.
okay. Anything else? Motion to adjourn? Maria pops right in there. Second, all in favor? Second, Tom.
I'll be the second. 8:04.
Wow.
That's record
Efficient,
time.
it's efficient.
We had
Should
one
share
that
more
was-
often.
I know. Ha ha, Tom.
Phenomenal.
Good job.
Well done.
All right, very good.